Now, in my earlier years of investing, it was all about finding small cap companies, small cap stocks, because those were supposedly easier to grow. Those big cap companies were not moving much. So everybody was buying, that latest small oil and gas company or that latest small property developer company back in the 2000s. But these days, things are very different. Everybody's investing in technology. Everybody's buying the big cap company that's growing faster and faster. And the disparity between small caps and big caps just seem to grow wider each day. In my opinion, it's all fueled by index investing, by ETFs, because ETFs just buy into market index. And small cap companies just seem to get ignored, in my opinion. But you think about this, small cap or small size companies are easier to grow, correct? Because in terms of percentage wise, it's much easier to grow when you're a smaller company. And when you're a small company, there's less analysts looking at you. I pull up this for you to see. You realize that it's proven that most analysts are devoted towards big cap companies, the big names, and small cap companies just don't have that much coverage. That is why there are causes that are run these days that help people, retail investors like you to identify small cap companies that are undervalued. But today I'm going to share with you a simpler method. Rather than finding that small cap company, might as well buy a stellar fund that's focused onto small cap companies itself. Saves you a lot of hassle, and I'm going to review that name to you in a while. So if this interests you, continue watching on. Hi guys, welcome back. Let me start by showing you a chart that compares across the various retail funds focused onto small cap companies. Now look at this chart over here. What do you realize? This is a year-to-date performance, and the two top performers over there have delivered 10% in terms of year-to-date returns, correct? The rest have just barely broken even. So let's focus on these two funds in particular, and I happen to be very familiar with them. The first, HGIF Asia X Japan Equity Small Cap. Now, this fund has been around for quite long. I've actually tracked it, I've actually recommended it for portfolios before, and let me share with you a little bit of the history. Back in 2017, they actually had to close this fund. It's called a hard close because there's too much money pouring in. It really happens. When a fund manager is doing well, a lot of money is pouring in there, and they actually had difficulty in finding enough good investment ideas, and they actually closed new monies coming into the fund itself. So, never heard before, something that I introduced to you. They actually had a hard close for this HSBC fund itself, Asia X Japan Small Cap. So what do they do exactly? They actually follow this growth at reasonable price model. Now, if you're a savvy investor, you may have heard before this term, GARP, and it's actually used by Peter Lynch. He's actually coined this. He's actually a practitioner of this. He's actually done fantastic with this, and this is how he stock picks. But do note also, every investment style has its ups and downs. Different seasons prefer different styles of investing. And actually in the previous email, which I managed to actually recover back, was that I actually queried the team itself why they underperform, and I actually showed this chart to let me present over here for you to see. What you realize is in the 2018 period, growth at a reasonable price was a method that was less favorable at that period of time. That's why this method of investing actually suffered quite a bit. They underperformed a lot of his peers in terms of investing performance-wise. And what happened very naturally is people give up on funds, correct? So when funds are doing well, people pour into it. When funds are no longer doing well, people move out of it, which is bad. You're buying high, selling low, and that's just going to not make investment returns good. So I've actually numbers for you to see. 2018, the fund size was 1.5 billion, but right now in 2020, it's actually dropped to only about $500 million. So it's actually lost $1 billion in terms of fund size. Really shows you that retail investors do wrong things. They move out when it's pain, and when things are looking good, they're actually having this fear of missing out and going in. That's why if you look around the internet, there's a lot of hype regarding ARK Invest, for example, by Catherine Wood. And right now they are a stellar fund that's done fantastic over the last 1-2 years. And a lot of hot money is pouring into it. But also do note, this is a good learning point. Things can go up, things can go down. Different seasons prefer different investing styles. So don't always follow the crowd blindly in a lot of ways. Now the fund that I'd actually like to cover with you more is actually the Pinebridge Asia X Japan Small Cap Equity Fund. And before I get there, smash on like so that more people can see valuable content like this. Now to start things with, small cap companies tend to be more volatile simply because there's less liquidity. So in terms of bear markets, when people want to sell out, naturally with less volatility, things can plunge a little bit more. I have numbers to show you. what do we see over here? Using Pinebridge HGIF Japan Small Cap Fund, it actually lost 59.8% in the 2008 global financial crisis. So compared to index STI, which lost 49%, and S&P, which lost 37%, it is true that small caps tend to be more volatile. But also, if you stick through the thick and thins, you will actually realize you have some gains. So next year, 2009, small cap, this fund itself actually did 101.1%. Comparing, the STI actually did only 64% in terms of recovery, and S&P only did 26%. So stick through thick and thin. Don't give up on the fund simply because market is plunging and stuff. Things will recover back, to normality in many crashes. So the main thing that I'd like to show you also is when we compare the Pinebridge fund to its peers, what does it look like in terms of volatility? And this recent crash in March actually highlights, because they are the ones in the light blue, and I'll circle it for you over there. Realize that it actually lost less than its peers, which means it's less volatile. And when it comes to recovery, they've actually done well, and the fund right now is actually at a positive 10% year to date. So in next segment, I'll actually look at the fact sheet with you and show you details of it. Now, if you look in terms of the since inception returns, it's 8.6%. That's way above the benchmark. And this number is actually came down a little bit because if you look over here for the past 3 years, the fund bit-to-bit rate of return has actually dropped a little bit. So previous years were double digits, more than 10%. So right now it's only at 8.6%. And this has a long track record, more than 26 years in the making. So this is actually a very good long-term track record of 8.6%, even if it moves forward at this pace. So let's move forward to some other key numbers. As you can see over here, what I want to show you is over here. It's very technology focused, IT focused. The fund way overweights in terms of IT sector compared to the benchmark. It also, of course, has some industrial allocation, some consumer discretionary, but the main takeaway is there's a lot of allocation towards China, Taiwan, and Hong Kong. Tech in China, Taiwan, and Hong Kong. But of course, the biggest holding is still APPEN. APPEN is still listed in Australia. So APPEN is still remaining as its top holdings across these years. Now, it's not only APPEN Limited. There are two other names on the top 10 holdings that I'd like to show you. They've been there for a couple of years. And let me pull this up with you. This is actually June 2018 compared with August 2020. So what do we see? Two other names, Shenzhou as well as Synbon Electronics, still in the top 10 holdings. In fact, these three are right now in the top 5 holdings of the fund itself. When we look in terms of fund managers, we want them to actively manage, which means change certain names. But too much churning may be, incurring unnecessary costs as well as showing not long-term investing. So for me, I actually like some names to be there, the core of it to be there, and it goes to show that there's long-term approach to the investing strategy itself. I'd like to end things by showing you this part that is mentioned by the fund manager Elina Fung, that she actually believes that when markets are volatile, you should invest in things, stick to things that you know. And I think her team actually believes in this saying, and that's why when markets are down, they invested into things that they are confident in, and that's a good investment approach. Now in the next part, I actually dive a little bit more onto APPEN, because APPEN right now is actually 6.3% in terms of allocation to the fund itself. So what exactly is APPEN Limited? I actually did a little bit of investigation, and APPEN Limited is actually into AI, artificial intelligence, and their shares have been climbing crazily. Look at this chart over here. You realize that this is a 5-year chart from Yahoo itself. APPEN Limited has grown significantly in market cap, and they are no longer a small cap company, but Pinebridge HGIF Japan Small Cap has still kept this holding, and possibly that's the reason why it's grown to 6.3%. And APPEN, being an AI company, has not actually suffered too much in this pandemic. In fact, they've actually announced that they are raising dividends. Not many companies in 2020 are raising dividends, and anyone that can do that is going to be rewarded by shareholders. So hopefully this gives you a glimpse that small cap companies are also worth investing into, and a simple way is actually investing into funds that get you that exposure. Pinebridge HGIF Japan Small Cap Equity Fund is just one name that I'm suggesting, but it also should fit your risk appetite before you get invested into it. And a further tip is it's actually CPF OA approved, which means you can use your CPF funds to purchase. And not only that, if you're looking for more ideas along this line, I have this previous video that I'd like to introduce to you. This fund has actually beaten S&P 500. So if you're curious about it, this fund is also CPF OA approved and can deliver you superior returns also. With that, let me invite you to that video and remind you also to smash on the subscribe button because we'll be launching videos every week to help you in your financial journey. With that, I'll sign off. Take care and goodbye.